A very good day to Doctor and my fellow friends. We are from Group A and today we will be discussing the topic on tutorial A, which is traded or market risk. And the question that we chose are question 4 and 6 because we found out that these two questions are comparatively more tricky and also more interesting. So I think it's worth to discuss. Next, this is our group members. So we actually distribute our work equally. We discuss and also tackle the question together, but for the presentation part, some of us will be preparing the slide and some of us will be presenting just like me. For question 4, define value at risk and state its limitation. How may this limitation be addressed? So let's talk about value at risk, VAR. The definition is actually defined as a single summary statistical measure of possible portfolio losses due to normal market events. It essentially quantifies the potential loss from market risk that can occur over a specific time interval and a given certain confidence level. So those two are actually a very important parameter of VAR. The bank or the firm, they can actually use this VAR to answer how much could I lose to help them to monitor and also control their risk. For example, a 10-day 95% confidence level VAR of $10 million implies there's only a 5% chance that the portfolio value will drop by more than 10 million over a 10-day period. Next, let's talk about the limitation of VAR. One major limitation is that VAR only captures potential losses under normal market conditions or events, and it fails to anticipate black swan events or extreme market shocks. This means that during a sudden financial crisis or global pandemic just like COVID-19, the VAR figure actually becomes virtually meaningless. Why? Because the market behavior shifts outside of the historical normals. Secondly, VAR provides no information regarding the magnitude of losses in the tail. It tells us that we might lose more than a certain amount, but it doesn't distinguish between a manageable loss and a catastrophic one that could lead to bankruptcy. Lastly, VAR relies heavily on assumed statistical distribution, especially the normal distribution, that may not accurately represent the reality. In the real world, financial markets often exhibit fat tails, meaning extreme price swings happen much more frequently than a standard bell curve would predict. After studying the limitation of VAR, next let's think of how to address those limitations. So a paper by Asabi and Tashe in 2002 addresses that VAR by using expected shortfall, which is ES. They prove that ES is a coherent risk measure unlike VAR and specifically address how to calculate it for both continuous and discrete distribution to ensure it remains robust in real-world trading data. On the other hand, Jorian Phillips argues that VAR's limitation must be addressed by stress testing and also scenario analysis. He mentioned how to use these two tools to simulate black swan events that historical VAR models would never predict, emphasizing on backtesting to ensure that the model's predicted risk actually matches its real-world performance.
Okay, now we moving on to the next question. So for this question, they ask us to compare and contrast the risk and payoff from the following trading strategy, which is for long position, short position, and also for the short selling position. So let's go to the next slide. First, we start a long strategy. This position we apply when we expect the price goes up, and the main risk is that the asset price may fall, but the total losses they may incur by the investor is how much they put in their trading. So the payoff from a long strategy is occur when the price rise above the purchase price and allowing the investor to make a profit. And next is the short position, where this kind of strategy arise when the investor aim to profit from a decline in the asset price. So the risk in a short position is that if the asset price rise instead, so the trader will incur a loss. So to understanding the graph, for the horizontal line, it represents the stock price. So let's say we assume this price is $100, and for the vertical line is represent your profit or loss, and the zero line is represent your break-even point, which means if the price goes up and down, in between the line, it determines your profit and loss. So we start for the long position first. So how it works, you buy the stock that you expect the prices go up. So if the line goes up and to the right, as the price increase past 100, your profit grow. So if the price fall below 100, you'll lose money. So the total maximum you lost is only $100. And for the short position, how it works, you sell the first, and the money you borrow, you expect the price is to go down. So the line is goes up and to the left. So you make a profit as the price drop towards zero. So if the price is rise above 100, you lose money. So the risk is how the red line keep going down as the price goes up, because a stock price can theoretically go to infinity. So which means your total losses is unlimited. Okay, now we moving on to the short selling position. So here is the specific graph comparing a long position and short selling position. So how to read this graph is, for the horizontal lines, which is stand for price, this show the stock price changing from the left to right, and for the vertical lines, it stand for the profit or loss. The middle horizontal line is your break-evens point. So above is profit and below is your loss. So for the short position, which is the red line, this represents your short selling, or you sell high and you buy low. So for the direction perspective, the lines goes down as the stock price goes up. This means a rising stock price is actually bad for a short seller. And for the profit perspective, you make money as the price fall towards zero. And for the risk aspect, it notice how the red line keep falling into the loss zone as the price increase. Since a stock price can keep rising forever, a short seller face an unlimited risk. So for the learning point that we can highlight, first, it is important to distinguish between the trading book and the banking book. So market risk mainly come from the trading books, which is market to market daily, while the banking book is managed under the credit risk and also the interest rate risk. So this separation help avoid hidden losses and also the incorrect capital. Second, market risk should not be measured usually using only the VAR numbers. We use position size, risk sensitivities, and also the different VAR methods. So since VAR does not full capture extreme losses, it is supported by expectant shortfall, stress testing, and also the back testing. And finally, risk measurement must lead to actions. So bank set risk limit, monitor breach, and also use hedging tools such as futures, swap, and also option. So market risk management work together with other risk area to control losses while still allowing profitable risk taking. So that's all for the tutorial discussion. Thank you.